All right, hello, welcome traders. Hey, it is July 8th here, 2025. Coming to you tonight, that market's down just a fraction in the today's markets, but we had a great day. Closed another zero DTE winner, keeps the streak rolling well back into last year on consecutive zero DTE winners. So that was great to have today, as well as closed a gold strangle today as well. So lots of good stuff happening. Went through our strategy builder today in the Discord with members. I think that was really good to see. It certainly helped me to see, am I positioned according to my trade plan properly? Am I doing things properly according to the plan? And there's a couple places where I'm starting to get a little out of kilter. So I think that's a great thing. I adjusted the plan a little bit and we'll let a few trades fall off. And we're just letting things work out right now. I think we're in really, really great shape, loving what the portfolio is doing. I've actually readjusted down a couple of the strategies from a percentage basis, up to few others. But right now, there's been so many great opportunities out there for trades that we're doing really well. And I want to take a few minutes today to cover something that I think is really, really important. And what I want to cover are five core principles of profitable options traders. And when I talk about these principles, it's primarily for options sellers. But I want you to understand what it takes to be consistently successful over the years. And I've been trading for pretty close to 40 years now, and I've made a bunch, I've lost a bunch, but overall, I have made an awful lot of money over time. Have I lost money? Yeah, I've lost 30%, 40%. I've lost 80% of my accounts, not recently, but in the past, I've lost entire accounts when I was younger, just trying to go from one strategy to the next. So I really honed it in. And yeah, are you going to lose? You're certainly going to lose. And if you're taking any risk at all, trying to make some money as a trader, you're certainly going to have some risk. But what we want to do is minimize some of that risk and set ourselves up for success overall, which is, I think, what we do. I don't mind taking some losses. It's okay. It's part of the game. You learn, you get better, and you come back and you keep making even more money the next time, and they all keep compounding and building. So you take three or four steps up, one step back, three or four steps up, one step back. It's not one step forward, two steps back, but you got to have a framework for trading success. So let me go through these five core principles that I have. I'll actually share a document with you. If you want the document, you can post it in comments down below, and can make it available to you as well. We'll make it available for all of our Discord members out there. But short framework for trading success. So let's get into it and go through some of these. So number one, trade the edge, not the outcome. I'm going to shrink this down just a bit, but trade the edge, not the outcome. What does that mean? Well, we're not in the prediction business. We don't know which way the market's going to go tomorrow. Is it going to go up? Is it going to go down? What we are in the business of is probabilities. I love probabilities and then using the right strategies based on the probabilities to give us the best chance of being successful. All right, so good traders focus on expected value, or what I call positive expectancy, which means if you keep placing that trade over and over and over and over and over hundreds of times, okay, throughout the year or years, okay, if you set it up correctly and you've got a good trading plan, okay, you are going to take losses. You're going to run into strings of losses, which is why most people get knocked out of the market. They take two or three losses on something and they give up. Ah, that's not a strategy for me. Okay, could be zero DTE, could be the 112, could be naked puts, could be credit spreads, could be ink iron condors. Okay, not everything works every time in every market. Okay, but if you set up a trade plan correctly, okay, and have positive expectancy, which means if I maintain an 80% win rate on this over time, am I going to win more than I lose dollar wise over that particular period of time? Or does one loss wipe out five, or one loss wipes out five wins and I can't really make money? I'm just treading water. That's what you got to avoid. So good traders focus on expected value or that positive expectancy. Winning traders think in samples, not individual trades. You can't get bogged down on just one trade. Oh, it's a winner, it's a loser. I shouldn't have done that. I'm not, I did it at the wrong time. You know what? No, it's just a sample size. Okay. Okay. That's just one trade. What we want to look at is a larger sample size. So your goal here is to place hundreds of high probability trades. Okay. Uh, Over time, manage your risk and just let the math work. Okay. Write that down. Let the math work. Ruthless execution of your trading plan over time. Next here, sell premium when IV is high. Volatility is the fuel. Use it when it's abundant. Okay, it can certainly help you. Now, there are some strategies that I advocate that I don't really care what the IV or IVR is on them because if I only waited to get high IV, okay, I wouldn't be able to trade on a more consistent basis. There are some trades that we have that don't really care what the IV is. However, on a lot of the spec trades and a lot of your opportunity trades, absolutely use IVR to spot some of those opportunities. Okay. IVR over 30, we want to be selling premium, strangles, naked puts, credit spreads, ratio spreads, those types of things. On good high IV, not crazy, but over 30, uh, it gives you a better chance of having that come off quicker there. It doesn't really change the probabilities of the trade. Okay? What it does trade is gives you a better chance of coming off quickly and a better chance of success overall. Okay. Now, high IV does inflate option prices, so we sell them when they're expensive. Note here, though, if you're always selling high volatility stocks at high IVRs and IVR ranks, okay, you're increasing your risk, which means do you want to constantly be putting on trades when risk is high, or do you like when risk is a bit lower? Okay. If you can't take the swings, then maybe stop looking at super high IVR types of trades. All right. Next thing here, big one for me, have a plan. Okay. So have an exit plan before you enter. Don't hold and hope. Have a mechanical process and then follow your plan. I almost want to underline that. Okay. But you got to have a mechanical process, but again, you got to follow the plan. Okay? You can't have a plan that says, hey, I'm going to stop out at a 2x loss. And then when it gets to 2x, you think, well, it looks like it might turn. I'm just going to hold a little bit longer. And then it gets to a 3 or 4x loss. Okay. That's where you have the problem. So have a target profit on your plan. Okay. Is it 50% of max gain or of credit or something similar on most sold options? You don't want to hold all the way to the end unless that is your goal longer term. Some of my longer term trades, I may go for 80, 90%. Okay. But that's because I don't mind assignment on those trades. In my trading account, I really don't want to get assigned. I don't want to own the stock. Okay. I don't care if I love it or don't love it. I don't really want to own it. I'd rather get out at 50%, take that money and put something else on. The 50% is usually quicker and easier to get to than the second, 20, 30, 40, or 50%. Next thing, stop losses. 1.5, 2x stops, 3x stops, whatever it might be on sold options. That should be your mantra here. And then rolling. Is rolling an option? When? To me, rolling is booking a loss on a bad trade and then entering a trade on that already bad and losing underlying at potentially worse strikes. I don't like rolling. However, there may be times where rolling is a necessary evil or something that you may be okay doing. If you just want to keep the dream alive, that's fine. But could you have taken that money, booked the loss, taken that same money and put it into something that's a better opportunity trade as opposed to trying to keep the dream alive? What's the difference of holding a losing Tesla trade when you could have closed that trade, put it into Nvidia, and made more money quicker? Okay. So it's up to you on rolling. And then assignment, know when and why it happens, and then understand what happens when dividends or when it goes deep in the money, what can happen on your covered calls or on your naked puts. Understand assignment, and is that something you're willing to take on? Understand the extrinsic value and how that works. Okay. There's times when assignment is totally fine and preferable. There's some times where I really just don't want it. Right? And then position size saves accounts. Even the best edge can get wrecked by overexposure. Trust me, I know. Okay, so risk more than no more than 1 to 5% of an account per trade. Don't go big on any one idea, so diversify by strategy, tickers, and time frames. Some of my more recent losses that I've had was not because I risked more than 2% per trade, okay, or risked more than 5% per trade. I didn't. Okay. What I did have was one strategy. I had too many trades, even though they were sized appropriately each, too much risk on. Okay. Easy solution for that is simply just diversify more by strategy, tickers, and time frames. Okay. Just don't ladder up and have a lot of trades of any one strategy in any one ticker at the same expirations. Okay. Do that, and you're going to diversify more appropriately that way. And then avoid doubling down on losing positions. Never double down, okay, or add to a losing position. Okay, let it go. I'd rather add to a winner than add to a loser. Okay, and then number five here, manage your emotions with math. Okay, control your emotions and let the probabilities play out. Number one here, be process driven, not results driven. Focus on the process, okay? Not the amount of money that you can make, not what the results are going to be. Just focus on following the process. Get ruthless on your execution, okay? Ruthless execution. I should even put that in here, okay? Ruthless execution of your plan. I mentioned it before. So be process driven. Just be right on the money. Let that roll. All right, next. Losses are part of the process. You're going to lose. It's all right. There's no trader out there that hasn't lost trades. Okay. And there's nobody out there that hasn't lost a lot. Okay. If you've never really lost or lost significantly, you're really not trading or trying to trade. Okay. You may have hopped from one thing to the next. The whole reason you're hopping around is because you keep losing and trying to find the right trade. Okay. Losses are part of the process, but if you have a plan, you're fine. Okay. And then over time, positive expectancy will win out with many of your trades. Okay. Let the trades play out by putting on multiple trades time and time and time again. Great example for me was, I believe it was last year, gold spiked up, knocked us out of some trades. Okay, maybe had two or three gold trades on again, maybe one too many trades in the same underlying, same strategy. Should have diversified a little bit more. But anyway, I kept just placing trades on gold after that. Many members, okay, and many other people I know stopped. I'm never trading gold strangles again, never again. Well, by the end of the year, gold strangles were actually very profitable over the year. Had I quit and stopped like most other people, I'd have never made any money. If I hadn't made maybe adjustments to my trade or kept letting them go, stop out at your stops, keep placing the trades over time, you're going to win. And again, it doesn't matter, okay, about what maybe the charts or anything else says. I think sometimes that gives you an edge. But number two, just let expectancy play out and let statistics drive your decisions. All right, so let's talk about the Consistent Traders Toolkit. So for you, IVR, which measures current implied volatility versus historical. If it's inflated, okay, over where it normally trades, okay, this might give you an option to sell premium for maybe a little bit of improved results. It can give you a bit of an edge. Okay, there's several things here that can give you a little edge, and all you need is maybe a little edge over the house. Okay, delta measures the probability of going in the money. Okay, it's a great thing to use as a guide for strike selection and your risk exposure. Okay, so delta gives you an idea of your risk exposure and your probability of profit. Right? So probability of profit, the next one here, estimating the probability of this trade ending positive. Okay, I want to focus on trades typically with a probability of profit over 70%. Some people may say 60, 65, 80, whatever it might be. 70%. If you have a pop of 70% or more, okay, if that allows your positive expectancy to play out, then that's where you want to be. Next thing here is buying power, which is the margin or capital that you use to trade. Help size trades appropriately, keeping your buying power consistent and keeping your buying power at certain levels. Okay. Some people like to also look at their overall buying power use by volatility in the markets. So when volatility is low, maybe your buying power is a little lower than normal. I don't really make a lot of difference, but I think when the volatility is low, the markets are typically at highs. I don't know that you don't want to be in the market when the markets are rolling pretty well, but if they get overbought, then I think that's when you want to scale back. All right, and then lastly, have a trade tracker. I've got a great spreadsheet that we use here, share with all the members in the Discord. Have a great trade tracker, log all your trades, track your entries, your exits, all your setups, so you can identify your strengths and weaknesses over time. I routinely will take my trades over a period of time, run them through some AI tools, get some feedback so I can figure out how to better tweak my consistency and the trades that I have on. All right. And then the last thing here is a pre-trade checklist. So before you enter a trade, here's what I want you to focus on, especially if you're selling premium. Okay, is IVR over 30? Gives you a little edge. Doesn't mean it has to be, okay? But it certainly can give you an edge when IVR is over 30 if selling options. Number two, is the strategy appropriate for your technical assumption? If you take a quick look at the charts, does the strategy you're choosing suit what you're expecting to happen? If we're in an uptrend that looks like this and you want to put on a strangle, I don't know that that's the best trade. If we come down and bottom and we're coming out of the bottoming process off of a strong technical level and IVR is great, then maybe I want to use a strategy like a naked put or a put credit spread. Are you using less than 2 to maybe 5% of your account in any one trade? Do you have a defined entry and exit? Are you diversified by ticker, strategy, and time? Or next one here, have you checked for earnings or dividend dates coming up? You don't want to be selling premium that crosses potentially over earnings by a couple of days or even a couple of weeks. Okay, if it's a long-term view, that's a different thing. Where if you're in stocks, it could really swing. Stick to indexes, ETFs, and you can avoid that. Next here, can you emotionally handle the worst case scenario? If this thing goes to zero, you lose or goes to a 2x on it. So if you're selling and the loss is twice your income or credit, can you handle that? What if it goes a little past that to 2.5 to 3x? Can you handle that emotionally? If you can't, you're trading too big or the strategy is not appropriate for you. And then lastly here, did you log the trade? So if you take these things, put them to use, I guarantee you're going to be a better trader. Okay. Hope this helps you. If you like some of the ideas that you heard here, please go ahead, click the like button down below. Get the word out. Let's see if we can share and help some other traders out there. I hope this was helpful to you. Hope you got at least a couple pointers and takeaways from it. We'll see you guys tomorrow. Stay safe out there. Trade your plan and plan your trades.